individual plays, you know. So you're looking at, for example, this trade here, and you can see, you know, where the buy trade came in, what the price was, you know, where the buys and where the sells came in. So, you know, they're not even the best of traders, you know. But so you can see that, you know, it breaks it all down for you, and you can check it out, you can look at it, you can think about it. It's not going to get you very far, but it just gives you an idea that to think that the markets do not have manipulation. I mean, seriously, to think that the markets don't have manipulation. I mean, look at that gold. We knew that gold was a buy trade, right? So what did they do with gold? You see what they did with gold? We knew gold was a buy trade. So what did they do? They ran the sweep. They took the price through the bottom edge. They ran the sweep. People bought it, and the markets went straight up. So you went from 33s to 37s. It's brilliant, isn't it? But that's just the normal. That's just the normal. That's the normal type of idea if you were looking at that, because that's what yesterday's classroom was all about, is rejecting a swing. Well, that's rejecting a swing level right there, isn't it? It didn't just reject the swing level, it also rejected this candle, because that candle low was there and the price closed above it with a pin in that entire space. There's the close of the candle. So what can you do? You're going to buy that candle there, correct? You're going to buy it. So you buy it there, and there's your money shot. There's your trade. You've just bought in at 33.60s. It's now traded 37s. Great trade, lovely outcome. Exactly as we thought it should be, based on the narrative that we were unfolding. Remember, this idea of buying, possibly buying up some treasuries on the dip, was giving us an idea that this could turn the market round a little bit. And that's where the buy trades came in on gold. Now, this isn't the first trade in gold. Remember, we've been talking about that buy trade in gold earlier on, when I suggested that on the basis that they didn't hold the price up here to sell it into the US Open, they're more likely to take it down into the London low in the US Open. Did I not say that? Of course we said it. So that's what they did. That's exactly what they did. They took it into the London lows to buy it, because they didn't hold it up here for the US to sell it. So we know that the story changed, and we changed with the story, right? We changed with the story. So we're able to then take advantage of the fact that we knew that this was therefore the likely location for any buy reversal coming in. And remember, on the basis that we were then offering the dollar, remember, we were offering the dollar at 1500 hours. Well, if we're offering the dollar at 1500 hours, dollar offers, right? If we're offering the dollar at 1500 hours, what does that mean for commodities? That means that we should be bidding commodities at low prices after 1500 hours as well, correct? Yes or no? Well, there's 1500 hours there, so we should be able to bid commodities. Is that not easy? Of course it's easy. And of course, it's not just politicians. Let's not just beat up on the politicians. I mean, it's you know, big executives that you know, it's, in fact, there's been cases in the UK of insider dealing. Believe it or not, there was a movie made of it, and I don't know if anybody's seen it, but there was a case in the UK of a bank cleaner. Has anybody seen that movie? Stealing inside information. So it was a cleaner. It's a true story. It was a cleaner that was stealing inside information from an office, and then they were putting that inside information out into their network to buy products or sell products or their shares. There's so many examples because everybody wants to monetize their knowledge. We do this legally in the horse racing industry. We still don't know what the other horses are going to do, but we know whether our horse is any good, right? So we can do this legally in the but of course we want to monetize that information. If I can get a horse that's rated at 75 in a race that's rated at 55, I've got £20 in my favour. £20 is like half a track worth of edge, right? You could ride that horse backwards and it's likely to win the race. So, you know, that's where you get your edges from in some sports betting. How many edges? Well, if you're a coach and you know that one of your top players is out injured, or you know that there's a, you know, we got an inside tip on a football game actually in Scotland. It was in the first division, so it was down a little bit, right? But we got an inside tip from one of the players in the team. Not because they were telling us that there was an inside tip, it was a conversation, and he says, look, half of our team are out with the flu bug. Can I monetize that? Half of their team were out with the flu bug. So obviously you look at the odds for the next game and you recognize that the odds are pretty much an even money bet, and you say, well, there's no way they're likely to win the next game, right? Even if the players play that shouldn't be playing, they're probably not going to be fit. And if it's their second team that are going out, then of course the chances are they're going to get hammered. They get beat 3-0 at home in a game that they should have had at least an even money chance of winning. And they got beat 3-0 at home. But because you knew that a lot of the players were out with the flu bug, you were able to then monetize that as a situation, weren't you? Inside information wins every time, every single time. So when we understand that, this is why a rejection of a swing high or a rejection of a swing low like this is vital information, because why did it reject? Why did this swing high not reject? Why did this swing high, why did this swing high eventually reject? Because there's something going on. That rejection brings us to the party. That rejection of any swing high or any swing low brings us to a possible play, and therefore we need to contemplate what just happened. Like this rejection of that swing high here brings us to the possibility that I want to make sure I bag my money there, because that shouldn't have happened. When it does happen, somebody took it up and then sold it. It's my default position on every trade. Somebody took it up to sell it. Somebody took it down to buy it. Somebody took the price down not to buy it. Somebody took the price down and they bought it. Right, good. Information that I can use. Information I can maybe use to make some money myself. So we get footprints of these types of deals, don't we? We get footprints of this storyline, and it's based around the volume arrivals, and that's what we're going to be touching on in Classroom today. Again, as we said, we'd cover this entire week, we'd cover this concept of effectively the GRT type process.